Welcome back to Talk Tickers. This is the show where we strip down all that earnings noise to get straight to the signal.
And today we have a big one.
Oh, yeah. Today we are opening the hood on a company that has been, the absolute darling of fast casual for a decade.
Has been is the key phrase there.
It is, because judging by the after-hours tape, they might have finally hit a bit of a wall. We are talking about Chipotle Mexican Grill, ticker CMG, and their Q4 2025 earnings.
It was a rough afternoon for the Bulls, for sure. If you were watching the tape right after the close, you saw some immediate fireworks.
And not the good kind.
Definitely not the celebratory kind.
No, it was brutal. Let's just set the scene. The stock closed the regular session around, $39.17. Felt totally fine.
Sedable.
And then the second those numbers hit the wire, the trapdoor just opened, we saw a drop of roughly 7% in minutes.
Pushing it right down into that $36.40 range. It's a big move for a company like Chipotle.
It is. And what's so fascinating here is the disconnects, right? Because if you just glanced at the headline numbers, you'd think, great quarter.
Business as usual. But the market looked deeper. The options market was already pricing in a huge swing, like 9.5%. So investors were already on edge. They smelled smoke.
They did. And this is that classic quality of earnings problem. You can beat the top line, beat the bottom line, but if how you got there isn't sustainable, Wall Street will punish you.
Exactly. The financials cleared the bar, but the engine under the hood, specifically traffic and transactions, it is sputtering.
We are not celebrating an EPS beat when the parking lot is looking emptier than it was a year ago.
No champagne for that.
So let's get the good out of the way first, because on paper, they did execute. Revenue came in at $2.98 billion. That's up 7.4% year over year.
Right, and they beat the consensus, which was around $2.95 billion.
And on the bottom line?
GAAP EPS was $0.25, just squeaking by the $1.24 consensus. So technically, they made more money than the analysts thought.
And they kept building, 132 new restaurants in the quarter alone.
And 97 of those had a Chipotle. That physical growth engine is still running.
It is. But here's where the story falls apart. This is why the stock took that 7% nosedive. The bad numbers. Comparable restaurant sales or comps, they were down 2.5%. Not great, but that's not the number that really scares me.
It's the transactions number.
Transactions fell 5.4%.
That's it. That is the number that matters. That's the whole story.
Let's just pause on that. Transactions down over 5%. That means that many fewer people actually walked through the door or ordered on the app compared to last year.
Precisely. For a growth stock like CMG, that is a flashing red light.
So the only reason revenue is even up is because the average check size grew, and like you said, they opened a ton of new stores.
They're masking shrinking organic demand with physical expansion. You can only play that game for so long.
And I think it's already catching up to them in the margins, right? Restaurant-level operating margin compressed to 23.4%.
That's down 250 basis points year over year. That is a massive contraction. Operating margin overall was down to 14.1%.
So you're selling fewer burritos to fewer people, and you're making less profit on each one.
Not a recipe for a premium valuation. Not at all.
Okay, so this is where management usually steps in and says, don't worry, 2026 will be a rocket ship. They give you a rosy guide to stop the bleeding. Did we get that?
I absolutely did not. We got a reset year narrative. Management guided full year 2026 comps to be about flat.
Flat. In this environment, flat is basically down.
The market hates flat. Investors wanted to hear the traffic was coming back. Instead, they were told to expect zero growth for the next 12 months.
And what about Q1 specifically?
Well, the CFO, Adam Reimer, he noted that the underlying trends for Q1 are actually tracking negative.
Negative.
Somewhere in the range of -1% and -2%.
Now, they did try to blame the weather for that, right? The Fern winter storm. I feel like I hear that excuse every quarter from someone.
Yeah, but in this case, there's some math to it. Reimer claimed the storm closed a bunch of restaurants and dragged Q1 comps down by about 100 basis points.
So maybe they're flat without the storm instead of -1.
Right. But flat is still not growth. And you can't blame the weather for a full year guide of 0.
Good point. Okay, so falling traffic, shrinking margins, flat guidance. I want to pivot to their strategy, though, because the CEO, Scott Boatwright, he dropped a stat about their customer that I think explains everything.
This was the aha moment of the call for me. Go on.
Boatwright revealed that 60% of their core customers earn over $100,000 a year.
60%.
60. This isn't a fast food joint competing for spare change anymore. This is a premium lifestyle brand.
It is. And that single data point dictates their entire strategy for 2026. This is the K-shaped recovery in action. They are not chasing the value menu crowd.
Those people are gone.
They are gone. They are doubling down on that premium customer.
And that explains the weird pricing strategy, doesn't it? Because they're not raising prices as much as you'd expect.
Exactly. That's the strategic part. Inflation for them, beef, avocados, is going to be mid-single digits, maybe 3 to 4%. But they're only taking price hikes of 1 to 2%.
So wait, if their costs go up 4% and they only raise prices 2%, they are voluntarily eating into their own margins.
They are intentionally taking the margin hit to protect their value perception. It's a really calculated risk. They know their customer is wealthy, but even a wealthy customer has a breaking point. So they're prioritizing traffic over short-term profit.
They're saying, we will make less money per burrito if it keeps you coming in the door.
That's the bet.
It's a bold bet. But you can't just eat costs forever. You have to find efficiencies. Which brings us to the HEAP initiative.
The high-efficiency equipment package. It sounds so boring.
It sounds like something out of a government file, but Boatwright talked about this like it was the holy grail. It's just better kitchen gear, isn't it?
It is, but the implications for the bottom line are substantial. They claim this new equipment improves prep time by 2 to 3 hours a day.
2 to 3 hours a day, that's huge. But how does saving time chopping onions fix the traffic problem?
It's all about throughput. That is the magic word for Chipotle. If you save 3 hours on prep, that's 3 hours of labor, you can move to the front line during the lunch rush.
So the line moves faster?
Correct. The number one reason people ditch a Chipotle line is because it's too long. If this lets them serve 10 more customers an hour at peak, that's a direct revenue lift.
And he also said it makes for juicier steak and chicken.
Which, frankly, they need. If you're the premium option, the food has to be premium. And this isn't just a pilot. It's in 350 stores now, and they're targeting 2,000 by year end.
That's a major overhaul. Okay, so faster kitchens, what are they serving? Because this is where I think the real story is for 2026. The menu is changing.
Yeah, they're moving to 4 limited time offers LTOs in 2026. That's way up from their usual pace.
Yeah.
They know they need news to drive traffic.
And they're bringing out the big guns right away.
Like an Outpaster.
A heavy hitter.
It returns next week, February 10th. And Boatwright was very specific. He said it is the most requested LTO in their history.
He said they get 2 times the social media requests for that compared to anything else.
I believe it. But there's another menu pivot that was, I thought, really subtle and really smart.
The protein focus.
Yes. They are actively, if quietly, catering to the Ozempic crowd.
The GLP-1 users?
Exactly. I mean, look at the data. They're promoting things like a 15-gram protein taco, an 80-gram protein bowl. And Boatwright noted that orders with extra protein, the double meat upcharge, are up 35%.
35%? That's a staggering number. And that's pure margin for them, isn't it?
It's the most margin accretive thing they can sell. And it aligns perfectly with that high-income customer who's either into fitness or on a weight loss drug and needs that high nutrient density.
So the playbook is keep prices stable to hold the customer, use tech to speed up the line, and then sell them double meat to make up the margin.
That is the 2026 plan in a nutshell.
Okay, before we get to our big takeaway, we have to mention the management shuffle. Scott Boatwright is firmly the CEO now, but the CMO, Chris Brandt, is out.
And that is a big deal. Brandt was the architect of that whole lifestyle brand era for them. He's why Chipotle felt cool for the last 5 years.
So what does his exit signal to you?
A change in CMO usually means a change in brand voice. And Boatwright hinted at it. He talked about leaning into product differentiation and quality.
So back to basics.
I think so. Less lifestyle, pop culture marketing, and more of a hardcore, our food is just better than their food message.
Okay, so let's bring this home for the investor. The stock is down, guidance is flat. Is this a value trap or a buying opportunity?
It really all comes down to the valuation, doesn't it? The margins are compressing. Now, management insists their long-term algo is still intact. They still think they can get to $4 million average unit volumes and like 30% margins eventually.
But 2026 is a detour.
It is a significant detour. I mean, the stock is in the penalty box right now.
In the penalty box, meaning it's just dead money for a while.
Pretty much. Until they prove traffic can turn positive. The flat guide removes any reason to rush in and buy this dip tomorrow morning.
Unless you're a true believer in the chicken al pastor.
Right. Unless you think that launch is going to aggressively beat expectations. Otherwise, it's a show me stock now.
Okay, that brings us to my favorite part of the deep dive. We've looked at the data, we've heard the call. Now it's time to pitch something creative.
Let's do it.
This is our This is not financial advice segment. Please, for the love of everything, do not trade based on what we say here. This is just an idea. But if we were pitching a wild trade to a hedge fund based only on this call, what would it be?
Okay. I'm calling this one the Soul Patrol dispersion trade.
The Swole Patrol. I love it already. Break it down.
All right, here's the setup. You go long Chipotle, CMG, and you go short a basket of traditional fryer-heavy fast food. Think Wendy's, McDonald's, the burger chains.
Long the burrito, short the burger. Okay, what's the logic?
It is a bet on the bifurcation of the American eater that Boatwright himself laid out. We have two critical data points. One, 60% of CMG customers make over $100 K. They're resilient to inflation.
Right. They can handle it. Whereas the burger chains are fighting for the low-income consumer who is totally tapped out.
Exactly. But here is the kicker, and this is where the Swole Patrol comes in. The protein pivot. That 35% increase in extra protein orders and the specific mention of GLP-1 users.
The Ozempic effect.
We are betting on a massive behavioral shift. The wealthy, health-conscious, Ozempic-using consumer sticks with Chipotle because it fits their macros. High protein, low carb. It works.
And meanwhile, the burger chains get hit from both sides.
They do. The lower-income consumer abandons them over price shock, and the health-conscious consumer abandons them because, well, it's fried food.
So the catalyst is the Q2 earnings print.
Yes. In Q2, Chipotle's chicken owl pastor bump coincides with swimsuit season, who never wants to be swole.
Wow.
At the same time, the burger joints report that their traffic is still eroding. You capture the spread between the two.
That is outrageous, but it's strangely plausible. You're betting on the wealth gap and the health gap at the same time.
The Swole Patrol dispersion trade.
You heard it here first. Just don't bet the house on it.
Please don't. The market can remain irrational a lot longer than you can remain solvent.
Very wise words. Okay, let's wrap this up. Recap for everyone in the back.
Simple. Chipotle beat earnings, but it failed the traffic test. Minus 5.4% transactions. That's the number to tattoo on your brain. That is why the stock is down.
And management is betting the entire house on operational efficiency, that new heap equipment, and better chicken to fix the whole mess.
We'll see if that flat guidance was a sandbag, setting the bar low so they can beat it, or if it was a genuine warning that 2026 is going to be a real slog.
Only time, and maybe the chicken owl pastor will tell. Thank you for tuning in to this deep dive on Talk Tickers.
Keep your eyes on the ticker.
And as always, none of this is financial advice. We are here for entertainment and education. Keep doing your homework. We'll catch you next time.